I think the market particularly the gold market and the Bitcoin markets are smelling, future money printing. Bond market a little bit less so. I've been kind of surprised at how well the 10-year has kind of hung in there in the mid fours.
Mhm.
That could change, but so far it's hung in. So we'll just have to wait and see. There's just a lot of inflation out there. I mean, it's just everywhere you look. It's in insurance, it's in food, it's in commodities. I mean, whenever I see a bad inflation report or, real life compared to the two or three that they're gaslighting us with, it's nowhere near a realistic estimate of what the average person is seeing. I mean, we're all seeing much higher rates of inflation than 2 or 3%.
Hey guys, welcome to Everyday Finance. Most investors make things too hard for themselves by looking for short-term moves, chart crazy, and ways to beat the market. That method rarely works, as history shows. You really have an edge if you can. Spot long-term fundamental trends early on and hold on to them. That's what Larry Lepard says in his main point. He says Bitcoin is still a small part of the $22 trillion gold market. So there is still a 10x runway before it becomes widely used in the same way that digital media surpass paper media. Bitcoin may soon be greater than gold as the next stage of change unfolds. Larry Lepard, with famous macro speakers that trading alpha is mostly a myth. The accounts that do the best are often the ones that aren't changed. It's easy for him to plan, buy, hold, and adjust. Most other cryptocurrencies will go away. But Bitcoin, Ethereum, and a few strong Layer 1 South will last. The lesson for investors is clear. Focusing on the long term is better than chasing short-term gains. And being patient could lead to huge returns.
A lot of moving pieces. It's a really tough call. I mean, I can't make the argument that it's a lot better off than it looks. It may not be
Mm.
as bad as the doom people think it is, and it's all going to fall apart. I mean, the employment is clearly getting softer. Consumer sentiment is clearly slowing down, but the airline data, people boarding airplanes is still pretty healthy. It depends on kind of where you look. And one thing
Mhm.
that's really holding it up is all this AI spending on data centers and electricity power and, et cetera, et cetera. I mean, we're spending billions and billions of dollars in CapEx to build out the AI network. And the other thing that's holding it up is just the stock market and the wealth effect of the stock market continually hitting all-time highs. I mean, I must say when Trump came out and said, we're going to put these massive tariffs on and the market took a 15% spill, I thought, all right, that's it. It's over. This is the bubble popped. And yet here we are. And,
Yeah.
people just bought the dip because they've been trained to buy the dip. And there's a lot of capital sloshing around out there. And so people, there are a lot of carry trades going on. And someday these carry trades will end. And someday buying the dip, I don't think will make sense because the dip will be bigger than they can solve. But so far that day hasn't arrived. And so, I think my last quarterly letter, which is available on my website, came out and I talked about how, it's possible that what we're seeing here is kind of a crack up boom, where everything is going up, including the stock market. And that's, gold's going up, Bitcoin's going up, stock market's going up, bonds are, flat. They're not falling apart, but they're flat. I think they will be going down eventually, but they're kind of, I mean, and one of the things that I think happened since you and I last spoke is, and this happened a month or two ago, recall that they came out with those and they said, we're going to cut 2 trillion, which was a joke. Then we're going to cut one. Oh, well, maybe it's 150. Well, I've looked at the numbers now and it doesn't even look like they're going to get the 150. No doubt they cut some silly programs and they saved some money. I give them credit for that. But in the context of a 1.8 to 1.9 trillion dollar budget, it's not that much. And then the big, beautiful bill comes along and adds, depending upon who you believe, between 200 and 400 billion dollars a year in expenditures, and defense spending goes up. And so, it's interesting to me the way the Trump administration pivoted from we're going to balance the budget, make America great again to, we're going to grow our way out of this. and honestly, there's an argument that says they really do have to do that. I mean, the way to get out of a debt spiral where you've got more debt growth than GDP growth is to amp up the GDP growth. But, and the healthy kind of GDP growth would be based on productivity. But the other kind of GDP growth you can amp up is inflationary GDP growth. And so, my sense is, the Fed is, I mean, and one of the things we know, and I think this is also going on in the markets. Okay, this is interesting. So we know, I mean, Trump's been attacking Powell, right? Just
Right.
ruthlessly. I mean, attacking him,
Yeah.
saying rates are too high, and Pulte, he got all these people involved, and Pulte and others involved. And what he's doing, obviously, is trying to put a lot of pressure on him, which it probably is actually counterintuitive, not going to work, because the more he pushes, the more Powell's like, screw you, I'm going to be Volcker.
Mm-hmm.
But here's the thing: the markets are forward looking, and what we do know is that in May, Powell's gone. So, the markets might be saying to themselves, okay, and even Besant has acted on this. I'll talk about that in a minute. Markets might be saying, well, okay, rates are higher than they should be right now, but we know with high confidence that in May of next year, there is going to be a new Fed chair and he's going to be a dove. And Trump said something along the lines of, we're going to take rates down 300%, 300 or 300 basis points or 3%. So that would take you from, 4.4, 4.5, whatever, down to, 1.5 or something. I mean, it's crazy. And, everyone's HELOC costs would go down. I mean, everyone's borrowing costs would go down. Borrowing would
Yeah.
explode, and so, I think anticipating all that, I think that's why everything's kind of hung together. It's funny, it's interesting too, because Besant, Treasury Secretary, when he came in, he really heavily criticized Yellen for not terming out the debt, which is to say, when rates were low, in the COVID era, she should have been selling 10, 20, 30-year bonds because the government interest costs would have been lower if she'd sold those. Now, I would argue that she couldn't sell them because there wasn't that much demand there, but whatever. She didn't
True.
sell them. She sold short-term bonds. She really tilted the whole debt refinancing game to being selling short-term bills that rolled over quickly. And people will buy short-term bills because they don't have duration risk on the interest rates. And so the Senate criticized all of that, but then of course he came in. He's been doing the same thing, doing what he criticized her doing. And my sense is he's doing that. And what happened is he got in there and he read the market and he got read in on. Guess what? There's not that much demand for these long bonds because everyone knows we're out of control on our spending. And so, in the most recent quarterly refunding report, he said, we're even going to tilt more heavily towards these short-term bonds. So I think what they're thinking is, okay, well, if we're financing the government short-term, and in the low fours, but they roll over pretty quickly. We know that we can do that, and then hopefully what will happen is when the new guy comes in, we'll cut rates down quite a bit, and short rates will fall quite a bit, and therefore we'll get our financing costs down as we roll over those short bills into new, cheaper short bills or cheaper interest rate short bills. So that's kind of the interesting position we find ourselves in betwixt and between the old Fed regime, but what everybody pretty well knows is going to be a new lax Fed regime. And because, Trump has just made it very clear. I mean, and he's not going to put somebody in there that's a hawk. I mean, he's just not. I mean, and whether Mirren is the guy or not, it's a little unclear. I mean, there's some language that said Mirren might be a placeholder until such time as Powell leaves, and then Mirren might resign. He might put somebody else in, like Walsh or whatever. But we'll have to see. It's unclear how it's going to unfold. But I think the market and particularly the gold market and the Bitcoin markets are smelling, future money printing. Bond market a little bit less so. I've been kind of surprised at how well the 10-year has kind of hung in there in the mid fours.
Mm-hmm.
That could change, but so far it's hung in. So we'll just have to wait and see. On the economy, what do I know? I just don't know. I mean, one thing that helped it more recently is when this whole tariff thing was coming through. There was you got a little bit of a tariff bump. Everyone's like, okay, well, if we're going to have tariffs, those are going to be inflation. That means things are going to cost more in the future.
Mm-hmm.
Maybe I ought to buy something now. And I'll cite a perfect example of me personally. Okay. I had a 12-year-old Ford F-150 that had 130,000 miles on it. It was pretty much shit beaten, close to being dead. And I use my pickup truck a lot. I like it.
Mm-hmm.
And I, Trump tax thing got passed. The big beautiful bill got passed. Well, first thing they did is they said 100%, depreciation. You can take all the first year depreciation on a truck or service
Yeah.
vehicle in year one. Of course, I'm gonna have to argue that I use it for business, and that may be a little bit of a stretch, but some of it I do use for business,
Yeah.
and carting books around. And
Right.
the second thing I thought, this F-150, I bought the very cheap, low end model with an 8-foot bed. This F-150 is in the high 30s, low 40s. Even though Ford makes a lot of stuff here, I just know there's going to be more inflation in the future. This is probably a good time to pull that demand forward and buy that truck. because I think in 2, 3, 5 years, trucks will be more expensive. So, and I'm suspecting some other people did the same thing. I mean, I certainly, I can't see how this doesn't push the price of all foreign cars up. You know, so and we're seeing, I mean, the fly in this ointment, Brandon, is that there's just a lot of inflation out there. I mean, it's just everywhere you look. It's in insurance, it's in food, it's in commodities. I mean, whenever I see a bad inflation report or real life compared to the 2 or 3 that they're gaslighting us with, it's nowhere near a realistic estimate of what the average person is seeing. I mean, we're all seeing much higher rates of inflation than 2 or 3%.
Larry Lepard's plan for engaging in crypto comes down to being disciplined. He says to put 80% of your money into long-term investments like Bitcoin, Ethereum, and a few other assets that have been around for a while and can handle changes in law, innovation, and price drops. For buyers who don't want to chase hype, these digital blue chips offer steady exposure to crypto's long-term upside. The last 20% can be set aside for guesswork, such as DeFi projects, new Layer 1 South, or new use cases. Larry Lepard calls this a tuition fee because investors learn by taking chances, making mistakes, and losing money, but they stay involved with new ideas. This 80/20ths rule helps solve the problem that all crypto investors have. They want to bet on the next big thing without losing everything on short-term bets. It's a simple method, but it's based on tried-and-true trading ideas that have been around for decades. They've just been changed to fit the volatile nature of crypto.
Check the CME rate cut site that gives you kind of the odds on that sort of thing. And right now, the market is saying there's an 86% chance of a cut this fall or in September. So he's certainly got the cover to cut. I mean, with this most recent, most people are probably aware of it, but we had a huge downward revision in the employment numbers maybe a week ago or a little more than a week ago. And that was, that gives him some cover. I mean, he's always said he's going to be data dependent and the employment market is strong, and therefore I don't have to worry about the rates being too high. This data would indicate that maybe the employment market's not so strong. And of course, Trump fired the guy who reports the numbers, which I thought was hilarious. But anyway, he's got the cover to cut, and in theory he should cut. And typically what happens is the Fed tries to kind of follow the 2-year rate, the 2-year U.S. rate, and right now the 2-year rate is 3.8, and they're at 4.445. So it's clear to me that the rate should be coming down, all else equal. What is interesting about it, in my point of view, though, is that Powell's a human being, and I think Powell knows that, he understands how messed up the system is. He understands that we're going to have inflation in the future. And he really doesn't want to be Arthur Burns. He wants to be Paul Volcker. And Arthur Burns was a Fed chairman who cut rates too early and let inflation run wild. And Paul Volcker was the guy who slayed inflation. And remember that Powell is out of his office in May of next year. I mean, his term expires in May of next year. So, it's not that far away, 9 months or so. And, he's basically thinking about his legacy. And, I think my gut is he's going to say, well, I want my legacy to be that I did not let him, I tamed inflation and I didn't let it come back. And therefore, I'm going to hang on to, these higher rates, even in spite of the fact that he says he's data driven, but the data suggests he should be dropping them. But I don't know. I mean, I'm a little bit torn on this one. I mean, it could go either way. Who knows? He did have 2 dissents. I mean, it would not surprise me at all if he capitulated and dropped them. But it also really wouldn't surprise me. I kind of rate it 50-50 that he's going to do what he thinks is best for his legacy, which is to continue to be a tough ass until he's absolutely forced to drop them. So we'll just have to wait and see. Tea leaves, and they're not saying it obviously, but if you read the tea leaves carefully, I think that's right. And I suspect, so I think they realize that we're losing our reserve currency status slowly but surely. It's not going to go away. I mean, but it's right. Slipping. And I think they recognize that we have to get rid of, being the world's reserve currency because of the, the Triffin dilemma effect and the way it's hollowed us out. And so I think they know they've got to go towards gold and Bitcoin. And then, so, it's unclear. It's very difficult to know how they're going to play these cards, but, they're not stupid men and they do understand the situation that we're in. and they have to do their very best to move us in a direction that gets us closer to where we want to be. And I think they're doing that with all the actions that we see. And it could result in some really big action where they do a complete reset. I mean, the problem is, some people say, well, that's fine. Why don't we just revalue gold to today's market value? Well, that'd be nice, but it would only get you, $1.5 billion or $1.5 trillion or something. I mean, to really get a big dent in the debt and, get it to the place where get our balance sheet to the place where it needs to be, I mean, you got to take gold to 10 or 20,000, and that would be kind of a shock. And geopolitically, I don't know if they want to do that. I mean, I'm not sure what the reaction of everybody else would be. So it's really hard to tell, Brandon. I don't know the answer, but I do feel like in this administration, we have people that generally speaking are on our side. I mean, JD Vance completely gets it. I mean, Luke Gromen has done some great work in his newsletters, pulling out quotes and statements that Vance has made about how, the resource curse of West Virginia with coal, and how having the reserve currency is really a curse, because it hollows out, it makes your currency overvalued, and then you hollow out your manufacturing. And the most recent place where that's really come to fore, and Groman also has done a great job of pointing this out, is just, we're having a hard time. We couldn't fight a war with China right now because China has a lot of the shit we need.
Yeah.
I mean, I don't know how much you've been following or reading about all this rare earth stuff, but we're woefully deficient in rare earths, which is why they made the $500 billion investment in I think it's $500 million investment in MP Materials, out west, and so we've got to really, and Trump's trying to do as much as he can, as fast as he can, and I applaud him for all of that. But I also say, as I look at it, and just like Doge trying to balance the budget, I mean, you've got 20 years of bad policy here. And, I don't care if Trump's God, you can't fix 20 years of bad shit in 4 years. Maybe you can start to turn the ocean liner in the right direction, which I think he's doing. But, it's going to take time, right?
Larry Lepard says the same thing that Raoul Pal has been saying for years. It's not hard to spot the trend. It's hard to hold on through the noise. Instead of chasing short-term trades, the real alpha comes from being in line with fundamental changes that happen over decades. That means putting Bitcoin, Ethereum, Solana, and maybe a few others in as core positions and saving the rest in a small, speculative bucket. Larry Lepard's 80-20 framework makes things less confusing by putting 80% of money into long-term leaders and 20% into higher-risk bets. This gives investors security while still letting them try out new ideas. Both Larry Lepard and Pal say that the real edge is being patient. There are many stories on the market about people making a lot of money quickly, but they are not common. The safest way to go is more slowly and steadily. Bitcoin's market cap is still a long way from gold's. $22 trillion, so the long-term chance is still huge.